Hi, everybody. I'm John Nersesian, Head of Advisor Education at PIMCO. Many of you may recall the original Secure Act that was passed at the end of 2019 and a couple of key provisions that were included. The first was addressing RMDs, previously required to be begun at age 70 and a half, extended to age 72. The second key provision under the original Secure Act was the elimination of the stretch IRA. The inherited IRA could be distributed over the life expectancy, not of the original account owner, but of the beneficiary, providing an elongated compounding and distribution period. Unfortunately, that was eliminated as part of Secure 1.0, requiring non-spousal beneficiaries to take distributions of an inherited IRA over a 10-year window of time. So what are some of the new provisions that are included in 2.0 that continue to enhance, if you will, this opportunity to set up a secure retirement for all Americans? The first is the extension of RMD age from 72 to 73 and eventually age 75, providing additional compounding and wealth creation to fund an increasing longevity for many retirees. The second key provision are catch-up contributions available to those individuals or plan participants age 50 and above. The current catch-up provisions in the year 2023 are $7,500 for 401k plans and $1,000 for IRA owners. These are additional contribution limits above and beyond the traditional contribution amounts afforded that unique cohort of age 50 and above. And there's an even accelerated opportunity for those individuals age 60 to 63. The catch-up contribution limit will be $10,000 or 150% of the current year's catch-up contribution limitation, affording an even greater opportunity to accelerate retirement planning. All of these numbers will, of course, be indexed for inflation on an annual basis. There was another change to the Roth account universe. It's the idea that Roth 401k plans are now afforded the same privilege as Roth IRAs to avoid required minimum distributions, none whatsoever, regardless of age, providing an even greater opportunity to compound wealth on a tax-free basis. Starting in the year 2025, newly established plans will be required to establish plans with a 3% required automatic enrollment or deferral opportunity for their employees, starting at 3%, automatically rising to 10% with a maximum limit of 15%. The qualified charitable distribution is another key provision that has been enhanced under Secure 2.0. You probably remember the original QCD opportunity. It's available for individuals age 70 and a half and above to take a distribution from their qualified plan, and instead of distributing those dollars to their own taxable accounts, increasing their AGI and all the negative consequences of that increase, they can instead direct these dollars directly to a qualifying charity. The maximum contribution is $100,000. That $100,000 limitation will be indexed for inflation on an annual basis. There's a second new provision, though, with the QCD. There's a lifetime opportunity of $50,000 that can be redirected from this retirement account to one of two split interest vehicles, either a charitable remainder trust or a gift annuity, as a way of retaining additional benefit from these redirected dollars. Keep in mind that the income paid from these charitable vehicles must revert back to or be paid to the original account owner or his or her spouse. What about 529 plans? What about the individual who has accrued additional dollars in their 529 plans? A new provision under Secure 2.0 allows that individual to redirect the unused 529 balance into a Roth retirement account for the intended beneficiary. This limitation is capped at $35,000 annually and the amount that can be rolled in this manner is capped at the annual Roth contribution limit, less any traditional Roth contributions made in that calendar year. So what are some of the planning opportunities that advisors and their investors might consider given these new rules and regulations? Maybe the first or most obvious is the Roth conversion opportunity. I know, 10 years ago, many of us evaluated the potential benefits and costs of a Roth conversion. Moving money from a tax-deferred account into a tax-free account by making a conversion and paying the current taxes on that lesser balance. What we received in exchange was tax-free growth and the avoidance of RMDs. The Roth conversion makes tremendous sense given these unique opportunities and enhancements. The qualified charitable distribution should be revisited as a way of fulfilling the charitable intent of our clients. So many are trapped in an environment where they're required to take minimum distributions, beginning at age 73, reporting the increase in ordinary income from these distributions. And these same individuals are fulfilling their charitable intent by making a contribution to charity in that same year. As we know, many individuals making this charitable contribution may not be deriving an associated tax benefit due to the increased standard deduction that is available. As a reminder, charitable contributions provide a tax benefit only under the circumstances under which an individual itemizes their deduction under Schedule A. By combining these two functions into one, the distribution from my retirement account, the contribution or donation to an intended charity, the individual can receive the associated benefit regardless of their itemizing status. And then maybe the final opportunity is to revisit our beneficiary designations. So many of us in our estate planning endeavors name equally a number of intended beneficiaries, maybe our children. Let's revisit, though, this opportunity, considering now the requirement of a non-spousal beneficiary to take distributions over a mandated 10-year period of time. Maybe I consider leaving Roth accounts, traditional brokerage assets, to my higher marginal bracket beneficiaries and designating taxable events, taxable assets, such as traditional IRAs or 401ks, to intended beneficiaries who are in a lower marginal bracket. The division of assets wind up equalizing, but the tax consequences over an intentionally selective methodology may lower the total tax bill paid by all beneficiaries. I hope that this review has been helpful to you. If you'd like to learn more about the Secure Act or any other of the advanced wealth planning strategies that we cover as part of PIMCO's Advisor Education Group, please contact your PIMCO account manager.